Awesome. Well, first and foremost, thank you for everybody on the call today, making time for us. We really appreciate that, and hopefully we'll share some insights and thoughtfulness that y'all can use in your daily business. Of course, we've got some calls to action here on the end here where you can connect with us, whether it's Dan, myself, David, or whomever on our side. Um, it's an interesting time in the business. So just real quick, my name is Rick Claypool, and I'll be moderating this, but I'm going to pass it off very quickly to David Ruffin and then Dan Marks. David's going to give us a really good look at kind of the credit view of the world and what may or may not be coming, and thoughtfulness in terms of his approach. And then Dan will give us a pretty good perspective on like client lens in terms of like how things are happening and what does that mean from a client perspective. So not just looking at the balance sheet, not just looking at the numbers, but like what's the reality of things around that. So we'll roll through this pretty quickly. We can go ahead to the next slide here. So we've got a couple of polling questions here out of the gate, and I hope hopefully y'all can see that right now. But we really want to get your sense on kind of some key priorities for where we are at this point in time. You know, it's 126. We are halfway through Q2 at this point in time, and so it's an interesting time to kind of like think about where we are, and 6 months from now we'll be back in the planning for 2027. So it'd be great to get your feedback at this point in time. So chime in, please.
I'm going to leave it up for just a couple more seconds. We've still got people answering.
So interesting results here. I think a lot of what we're seeing right now is tension around credit quality. And it depends, I think, on to a large degree on like where you sit in the house. Because the other thing, and I think Dan Marsh will speak to this quite eloquently in a moment, um, which is, you know, customer or member acquisition. And that's a right? It's really frustrating right now to try and push through some of the things that we're dealing with and some of those elements right now because the the flatness, if you will, of where that is and how that's working right now in terms of member or customer acquisition is it's really a struggle. So it's not surprising that that would be relatively high, but at the same time, what we're seeing is some storm clouds around credit quality. And so with that, let's turn our conversation today. So what we see in terms of the numbers, it's it's a recurring theme. There's a lot of bullet points here. Here's what I would say. My observation, and I would be very curious to folks to like put comments in the chat and such. my observation is if you look at the underlying economic fundamentals of what is true around the industry right now, things are improving. What's concerning is this notion that the second to the last bullet point there is in summary, fundamentals are strong, but we're concerned that a storm is brewing. And it's a little bit of an old hat conversation because, we've been in this for a long period of time. And, hey, it's gonna happen, it's gonna happen, it's gonna happen. I think David will speak to this in a moment, but what's true or what appears to be true is I think we're starting to get there. There is clearly and presently some weakness with our clients and what we're seeing in terms of very specific loan quality and very specific credits. Is that symptomatic of a macro problem? It's hard to say, right? But it's more prevalent right now. There's more heat in that space than there has been in some period of time. So while it's true that NIM's second bullet point here continues to expand, and what we're seeing is a lot of health in the industry. And this is what we talked about maybe 90 days ago in our last conversation. There's a lot of help, but it is definitely concerning. And I think for every institution, it becomes one of these issues of, frankly, accounting practices. How conservative are you being? How are you thinking about loan loss provisions and how are you addressing those at this point in time or not addressing those? You might look at what you're doing. If your approach is more conservative than some of your peers, your numbers are not going to look as good as your peers. But you're accepting a practical reality that maybe perhaps some of us are not. And so these are things that they're nuanced and they don't necessarily come out in a manifest way in terms of the call report data, et cetera, because it's the individual choices, so to speak. So it's a really interesting conversation to me, at least, and all that stuff. So let's roll to the next slide. So what do we see ahead? We see continued stress brought on primarily by energy prices. This dynamic of what's going on right now is really, really troubling. It's really hard to predict. And it's really hard to understand. If you go back about 14 plus years ago, that level of what the energy crisis was and in that period of time, it was certainly a thing that impacted us in a negative way in a lot of different ways. But we're not manifest into that fully at this point in time. So what I mean by that is borrowing bases are really not being impaired at this point in time because where we are in the cycle of energy is it's going up and down so quickly that we're not really sure what's happening. And so the speculators, if you will, on all these spaces are just quizzical to put it quite frankly, quite bluntly. So what we're seeing is this ongoing and sporadic softness in credit quality. And I think a lot of it does pair back to where we are. I think the root cause personally is in energy. I would encourage you folks to offer up some thoughts in terms of in comments and commentary on what you think some of the issues are. But all of it gets to this disparity between there are really, really positive, good trends in the economics of our industry. Yet there are things that are definitely just scroll through this real quickly. What you can see here is again, top left, median asset growth, very strong, right? So, on a historical basis, very positive, right? Scroll the next one. The loan growth, similar story, right? So this is one of these things where the loan growth is happening, is manifesting itself in a way that the yields are still very positive, and they're passing the way back through into positive net interest margins. Next slide, please. You'll see here with the NIM growth, the forward deposit growth, the pass through on this, while this is down, you're going to see about 9 basis points pass off on this that is corollary to where we are on yields on earning assets. Next slide, please.
Hey, Rick, I think we're having an issue hearing you. Attendees are having an issue too. Do we want to just jump ahead to David's portion? Is
I think
that
that's fine. Again, I
okay?
apologize.
I didn't mean to interrupt. I know you were having a technical issue. David, is that okay?
Yes,
Okay.
absolutely.
And actually, I'm going to stop sharing and then you can pick up the sharing.
Okay. Hopefully you can see the screen. Okay, good.
Yes, I see your slide.
Okay, so again, as a segue to some of the data that Rick unfortunately is uh, having audio problems, is that relative to the funding issues, which we do kind of pivot over to as a segue into the regional compares. And of course, remember, this is our peer performance measure or index, which is basically a matter of 10 billion and under in terms of asset size. So what you're going to see here consistently is a little bit of focus on the Northeast banks. They have the largest dependence on funding, the Southwest, the least dependent. The gross loans to deposit have been pretty flat in the last couple of years. Again, the same bookending of that, but the logic is very similar. If you've got a little more deposits, you're going to have a little lower loan to deposit. As far as credit quality is concerned, and Rick did mention this, I've said this many times on these quarterly get-togethers. Being a credit guy, I quite am aware of my credibility to not focus too heavily on the negative or as if the sky is falling or what have you. But we really are looking at some data, I think, now that I'd like to share with you that does give us a little bit of a concern. Again, Rick was alluding to this earlier on. We've got some macro issues in the economy that are clearly there and are clearly creating degrees of uncertainty. The international conflict, which is creating an energy cost spike again, heightened inflation that seems to have reared its head again for the highest level in a couple of years. We've got some weakening to unstable consumer spending that's beginning to be quantified. The Fed projects the Atlanta Fed came out a couple of weeks ago and projects a fairly tepid GDP growth for first quarter of about 1.6%. As you know, anything under 2% in this era is considered a little weak. But we also know that again, credit is the big elephant in the room here. It's been generally acceptable. But again, I would like to give you some data that shows us a need, I think, to be much more vigilant, particularly in the short to intermediate term. One of the things that I've spoken to in the past too is that we tend to be captivated by kind of Wall Street financial news. And the interesting thing here is that, and I'm no economist, so I'm not trying to imply that I am, but I can't help but think that with all the investment of technology and chasing AI and so forth, which is quite understandable at some level, is this somewhat masking some of the subterranean aspect of our economy where we are still seeing that divergence between the kind of K style economy between the so-called paycheck to paycheck, people that are struggling more with some of the higher costs and potentially some of the repayment capabilities in terms of credit versus some of the more well-heeled. There is another troubling issue here, and this tends to be a leading indicator for particularly credit quality. We literally are, and I was teaching at the School of Banking in SMU 2 weeks ago, and their dean of that school is a noted national economist. He said he showed evidence that consumer sentiment was now at the lowest and it's been since the Great Recession. So that's a pretty strong statement to make in terms of, and again, consumer sentiment does tend to think in terms of, how much people are willing to borrow to, improve their lifestyle or what have you. Again, I want to reemphasize most of the data as we sit today by historical standards are still quite acceptable. There still seems to be that ongoing issue of CRE subsets that I'm going to speak to a little more in detail in a moment, which is particularly in multifamily, and then the recurring issue that we have disproportionate exposure to CRE by the community financial institutions. We've clearly seen in our work, and I want to make this across the board, the biggest single risk driver in credit quality today is not CRE per se or C&I per se. It's the industry that you're lending to. Please make sure that whatever focus you're having through your underwriting and servicing of your credit portfolio, that you put a significant emphasis on what industry there is that you're lending to, either prospectively or in place. There continues to be growing concern over the potential for private credit issues spilling over or lapping over into a more systemic effect into our economy. We are certainly seeing more risk grade degradation. I've spoken to that the last 2 or 3 quarters, but we're beginning to see in data that doesn't come directly from loan review recommendations for downgrades, but also with our portfolio analysis tools, we're beginning to see that banks are beginning to show on their own, which is the way in a healthy bank it should be, that you're beginning to identify weakening credit and that there are, again, continuing migrations to more lower level risk rating, low pass risk rating. Again, we're not seeing a huge significant trend into criticized classifieds at this point. We're certainly seeing a change in regulatory philosophy that came with the new administration. There's some positives to that. I think, frankly, it gives banks the ability to live by their own wits, manage your own sense of credit risk. I do think, however, every regulator I've heard speak in the last 6 months has said if there are indications, particularly in call report data, that deterioration is occurring, that's when more of a reversion back to a more traditional heavy oversight of regulatory review would probably be instigated. And I do think, as Rick did share a couple of times, I think we are looking at some potential reserve pressure, particularly at the community financial institutions. I think this graph, while busy, just from an optic standpoint, kind of says it all. We're having increases in the NPLs or non-performing loans, and we're having declines in our ACLs to the NPLs. For example, again, it sounds like I'm picking on the Northeast banks now, but as you can see here, for the first time in at least 5 or 6 years since I've been doing these webinars quarterly, We now have a regional aggregate region of our country that has now depleted its entire reserves against the inventory of NPLs, which is the Northeast. That's literally sitting at zero. And again, that's not anything to do with low pass or deteriorating credits as we sit today. These are tied to criticized classified loans that are already acknowledged through public data in the call reports. This is the more traditional way we look at reserves. Again, and they're kind of bookended by you've got the West at 147 basis points. The Northeast, again, is just a tad over 100 basis points. But again, remember, they're at least in theory, on the aggregate of the 10 billion and under at Northeast banks, they've depleted their reserves against their acknowledged inventory of problems. I haven't been showing this chart in probably 2 or 3 years because, frankly, as you could see, up until very recently, charge-offs have been very flat. But I think this speaks for itself. Look what's happened, at least proportionately, just in the last quarter. So we are seeing clear evidence that there are some concerns in terms of credit quality. Texas ratio, which is, of course, a thumbnail for investors and regulators, again, upwards sway of the trajectory of that. Again, we haven't even talked about Texas ratio hardly at all in 15 years. But again, you can begin to see, and again, I'm picking on the Northeast, it seems, they're the highest of the Texas ratio in terms of where what potentially credit quality concerns may be. The traditional concentrations that we look at in terms of CRE, the broader scale on the right, has begun to flatten out a little bit, which is the 300% guidance. The subset of that is construction loans and development lending. As you would expect, the Sun Belt states in the Southwest and the Southeast would lead that measure because of the growth in population and the presumed expansive commercial opportunities that tend to be more biased to those regions at this particular point. But generally speaking, have begun to flatten their trajectory at community financial institutions in terms of large exposures. Again, multifamily, I have to say, remains at this point, for me, at least for our team, the biggest concern of the subsets of CRE. I was speaking in Austin, Texas 3 weeks ago, and Austin's certainly a dynamic growth city, but real estate brokers indicated there were 2 very large apartment complexes going into bankruptcy. That they said they hadn't seen that since the Great Recession. So we have to take that in consideration. C&I is not significant in terms of its movement. Ag, of course, as you would expect, remains much more predominant in the Midwest. So in conclusion, what does this mean? I think, again, take some inventory and try to be prepared. Remember, under the current regulatory philosophy, there's a lot of self-policing, and a lot of bankers embrace that. A lot of bankers have been looking forward to that kind of sense of give us some space to kind of measure our own risk. We may be, from a credit standpoint, at this point, going to be testing that quicker than we may realize. So again, here's a kind of a laundry list, if you will, a checklist, updating your policies, understand industry risk, as I said earlier, clearly understand the supply and demand of the various markets. We're having to dust off our strategies on workout capacity. Much of that quality has long since left the banking industry that was there in some degree of surplus during the financial crisis. Make sure your board is aware of, at every step of the way, where you are in managing credit risk and any kind of pivots you're making in terms of your philosophy of how you're underwriting and servicing your loans. As we always do, like to kind of focus on the 3 pillars. Make sure loan review is doing an adequate job. You've got quality people doing the loan review whoever and in what methodology you use or options you use, we're big advocates of actually doing stress tests before your loan review. And the reason we do that is one of the key deliverables at Optima FI Credit Risk is that we always, irrespective of all the theoretical modeling we do with uh, stress testing, and that's frankly why a lot of people are not very enthusiastic about doing stress testing. We always share the specific borrowers that, upon the realization of that theoretical stress, these would be the borrowers you would really consider to be front burner and push to the front of the line to make sure you've got current financials, you've done annual reviews, you've done loan reviews on these. And again, the portfolio analytics is probably one of the is more critical now than ever, and that's where you get to see within your bank's portfolio aggregated trends that could give you a sense of here may be some hot spots that we need to drill down on and to put a little more focus on. So I think at this point, Dan, I'm will gladly stop sharing and hand it over to you, sir.
Yeah, thanks, David.
David, before Dave jumps in, so one of the things that's true here is obviously we're looking at lagging data, right?
Yes, yes. Thank you, sir.
Right. And you're experiencing working with clients some real-time qualitative things.
Yes.
Not to make you, the black hat in this, but like, can you speak to some of the things that you are seeing right now with clients?
Yes, and I think you're absolutely right. Some people have heard me say this. It's kind of a corny expression, but it's true. And that is if you wait totally until call report comes out to either assess or manage your credit risk, those horses are long out of the barn. The reality is the real art of credit risk management is applied on the migrations of your loans within the past categories, not into criticized classified. So yes, thank you, Rick, for making that point.
Yeah, so like Rick and David mentioned, we're the kind of the next stop in the update tour is what's happening with customers. And so the data point we're drawing upon here is a very robust sample that really represents about half of U.S. households and an intersection that is about $30 billion of balances generated for clients with tactics. And so the framework for that is the Optima FI. This is the kind of the old Infusion normative database has specific intersections of product behavior at your peer banks in the context of over 50 million households. And so it's billions of data points on how consumers and businesses interact with products at kind of a macro customer bank level. The twin of that is the application of when we work with clients on marketing campaigns, we understand a specific treatment of when we offer a rate in a particular channel mix and campaign package to a specific segment of customers. What does that do and how does that compare to peers? And so those two perspectives is really informing our perspective on what's happening with customers out in the real world. And so it's kind of in one sense, it's a top down as well as a tactical bottoms up approach. But really, even before we get there, some of the macro factors that we're seeing that are affecting decision making is, we are seeing deposits continue to grow as rates decline, right? Sometimes there's this sense that when rates decline, does that impact demand because you're not paying as much and money's going out, to other alternatives? But we're not seeing that yet. And so if you look at the Fed data as well as the PPI data, but the factor out there is we do know that oil shocks can spike in inflation, cause economic headwinds. And so, one of the the elements that Rick touched on was, the last time we saw a really substantial oil shock in about 5 years ago, we did see the rate of industry aggregate deposit growth decline by about half, and then of course it creates some of the other stresses that have already been covered. And so, that is something we're watching carefully on, that's going to impact consumer decision making. But as it stands right now, we're seeing, ongoing, very steady progress. And so the average balance in aggregate checking balances per household at banks across the country is up substantially, right? And so one of the things that that can be an early canary in the coal mine is as you start to see stress on the average balance in checking accounts, that can be a signal of consumer stress. There was a large bank recently that announced they're starting to see a slowdown in debit and credit payment activity, card payment activity. But as of the latest monthly data that we have off of specific household behaviors, we're actually seeing aggregate checking balances at a household level reach an all-time high of over $14,000 on average. And but what is happening is the penetration rate of interest checking is coming off a little bit of a peak, and so that's not uncommon when you start to see interest rates decline. Certainly, one of the low parts in recent memory was when we were in an extended zero interest rate environment. People didn't care about interest checking, and so we had started to see it climb. That's ticking back. Thinking about some of the interest-bearing categories, we're seeing all-time highs in CD penetration, so almost 11% of average U.S. households at banks have a CD. Now that's something key to keep in mind, right? Like not everybody buys a CD, and so when you think about your growth strategy, all things to all people, communicating to all customers the same way. Only a fraction of your customers are CD buyers, but the average amount of money held in CD continues to tick up. Certainly, consumers are more interested in fixed rate products in a declining rate environment and in periods of stress. And so one of the value propositions that a bank offers is that FDIC insured stability. We are seeing kind of the inverse a little bit on money market. So as rates tick down, you're starting to see people a little bit less interested in terms of on a macro penetration basis, having that money market kind of high yield, but the average balance is much more steady, and so that's penetration stats. When we look at actual campaign response, it's very interesting that CD demand or a responsiveness to CD campaigns was well above the long-term average as recent as 2 or 3 years ago. That has reverted to the mean. So we see a very long-term average CD response rate of about 2%. Q1 2026 came in right in line with that long-term average. So what's going to feel like lower demand for CD is really just that reversion to the historical trend. Money market and savings is much more consistent. So one of the takeaways from this chart is there are low-cost deposits to be had with mining your customers. And so if you need funding, if you need to drive down your lower cost of funds, even among a kind of a slowing macro tailwind, there are things that when you take a data-driven approach, you can drive some nice base hits within your portfolio. You don't have to go out and pay up for those low cost of funds as you beat those deposit needs. Thinking about the other side of the balance sheet, when we look at what's happening with kind of unsecured installment loans or home equity loans, we are seeing average balances go up on those, and so that's a sign of consumer health, right? When they start feeling constrained, and then if you think about these loans have to be approved by your credit profiles, and so in periods of borrower stress, you're starting to see you would start to see those balances declining on newly originated loans and even as utilization. What's interesting though is there's definitely a very different perspective when it comes to unsecured credit, i.e., credit cards. So we're seeing credit unions be much more aggressive at offering credit cards to their members than banks. Now, some of that reflects just capabilities and priorities, but we're seeing banks be more conservative and consequently have lower utilization rates. And so, in the type of credit environment that David mentioned, it's not terribly surprising that you want to pull back from unsecured credit, but credit cards can offer a very nice risk adjusted return on capital because of the fee income benefits and those kind of things. If you have the capability of managing the credit risk and extending and really focus on offering to current customers where you have other collateral as opposed to going out to brand new prospects. And the last trend that I would just mention is we are seeing a somewhat upward sloping trend at both credit unions and banks in terms of response rate to loan campaigns. And so, that could be a sign of health, but that could also be a sign of just as consumers are getting stretched, they're that much more interested in deposits. But if you take this stat and think about what we're seeing on the health of the checking balances, this would tell you that there's actually still nice risk-adjusted returns to be had in expanding your credit relationships with current customers, being very methodical, where we have more insight into what their financial behavior is. You have all offsetting capabilities, and so if you're looking for cautious credit growth, I would say the data here which suggests there's a nice opportunity of taking a data-driven approach to mine pockets of nice risk-adjusted opportunity within your customer base on both sides of the balance sheet for credit as well as deposits. So you're able to grow at a more moderate cost. You're not having to give away the store on either the cost of funds side or thin margins on the credit side, and we're seeing very nice responsiveness. We got about 4 minutes left on this session, and so if you are interested in really digging into some of the opportunities within your base, I mean that perspective of we have billions of data points at peers all over, we can dive in and give you a specific assessment of your embedded customer growth opportunities, deposits, loans, fee income, all those things. It's a very rapid process. We'd love to talk to you more about that. We just touched on some of the data points that are informing that analysis today, and so that would be one thing to take advantage of if you haven't already.
I think.
Go ahead, Rick.
Just real quick, Dan. I think one of the more interesting things from my perspective, you talked about the correlation of credit card utilization rates and the increasing balance of checking accounts, right? So if we just kind of step back from that, say, like, okay, so what's true about that? What's driving that? And to Dan's point, he elucidated a lot of these really good points here. That's what Dan and Trevor would, speak to in this session. They're going to get under the sheets, so to speak, and really push through the customer lens of like what's happening. So if you want to learn more about that, I think it's a great opportunity.
Yeah, thanks, Rick. We'll have our next we'll have this session again in August where we'll look at the next quarter results. Would love to be a resource. I mean, one of the things that's great about these kind of sessions is we're able to share kind of high level, but we also have, the three of us and all of our colleagues have one-on-one conversations pretty much all day, every day with bankers around the country on these topics that matter to you. And so we love having those conversations. Being former bankers ourselves, we all have a passion. Speak to everybody on the team for those kind of things. Even before the August, we've got a few other sessions. So Steve Huntington, who many of you know, is really the wonk of analytics and call report insights, and he's probably forgotten more about analyzing bank financial statements and peers than I'll ever know. And then, of course, Rick, who's been doing this for decades. We will make sure Rick has better audio quality before this session. So as we test and learn everything we do. So these sessions are coming up on both Call Report Insights and CECL. And then, just as we wrap up, our mission as the Optima FI team is to help you thrive. Community bankers are in the trenches every day. You guys care about your communities. We care about helping you be successful. We know there's not that many hours in the day, and so we love being your partner and applying our perspective and really syndicating insights from around the country to help you thrive, help you optimize every element of your performance. And so the three pillars of Optima FI that bring together that we've touched on today, from a growth perspective, helping you use data, both quantitative and qualitative insights, to systematically acquire, onboard, and expand relationships. That's the growth pillar of the old Infusion Marketing Group. David leads the credit risk pillar, covering all the things from third-party loan review, portfolio analysis, stress test, CECL, M&A due diligence, everything related to really protecting and defending the credit part of the balance sheet. And then Rick really pulls it all together from a balance sheet perspective, thinking about profitability, understanding those balance sheet trends, and supporting your treasury exercises. I can't talk. Exercises in terms of CD Marketplace, Call Report Insights, and then our brand new product, Household Insights, which is really infusing insights from really across all three of our pillars to helping time-strapped CFOs understand quickly those kind of embedded opportunities of what are the customer actions that are necessary to drive balance sheet outcomes. And so thank you for the time. We are available to hang around to do more questions if you would like to, but we try to land the plane right at 45 minutes, and so that's the time.
Dan, excuse me for interrupting, Dan and Rick. I did want to say weren't able to announce it today formally in the presentation, but we are planning probably a mid-June credit conference relative to online, either a webinar or a coffee talk, because I do feel like, given what we've talked about today, this would be a pertinent time. And obviously that's going to be directed in many ways towards interchange from the attendees. We'd love to hear your opinion and your perspective on what we've talked about.
Yep. Thanks, David. So yeah, happy to take any of your questions if you want to chat those to us.
Yeah, I'll also mention, Dan, if anybody looks in the chat, we also have a link there if you want to request a complimentary copy of the 2026 performance trends for your state or for the national report.
Awesome. All right. I do not see any questions in the chat, so we want to say thank you again for your time today. Hopefully this has been helpful, and we look forward to continue to have the dialogue even after this conversation. If you have questions, just shoot us an email or talk to us that way. Thank you.
Thank you so much.
Yeah, we're grateful to you all. Thank you for your time. Appreciate you. Thank you.
Thanks, Scott.